Hello, folks, and welcome to today's episode of the Hospitable Hosts podcast. Today we have Amanda Han with us today. Amanda, welcome. Thank you for joining us.
Yeah, thanks so much for having me, Miles. I'm excited to be here.
Excellent. Amanda did actually join one of our masterclasses a few weeks back, maybe a few months back, depending on when you listen to this. But we've got lots of tax questions, so we've invited Amanda back. Maybe you can give a bit more context, Amanda, on why we've invited you here, why you're an expert, telling us about tax today.
Yeah. Well, yeah, I had such a great time in the master class talking with everyone and just kind of answering questions. So for those of you who didn't join us last time, my name is Amanda Hahn. I am a CPA. What I tell people is I'm a CPA by day and real estate investor by night. So I'm also an investor, just like most of you. And my company, Keystone CPA, we have a passion in helping real estate investors nationwide on how to use real estate to save on taxes. And because our audience is mostly or primarily short-term rental investors, I talked to Miles and I said, I think this is a great idea for us to really take a deeper dive into what are the tax benefits of being a short-term rental investor. Because for me as a real estate CPA, it's actually one of my favorite topics to talk about because short-term rental tax benefits apply to virtually every short-term rental investor. So it's a sort of a must know in this specific investment arena.
Cool, awesome, I love it. And that's exactly right. So that's what we're here to talk about today: taxes for short-term rentals, and really looking at kind of some of the loopholes and ways of saving money, basically, on your tax returns. So firing straight into it, Amanda. First question for you: looking at write-offs, what can investors write off when they are investing into a short-term rental?
Oh, that's a great question. I think that's probably the most common area of confusion, I think, for investors everywhere. Because, the tax code is pretty complicated, right? It's thousands and thousands of pages. And although we like to talk about tax write offs and how much money people can save on taxes, but I think when I meet investors, uh, really the heart of it is people are always super confused about what can I actually write off. Like as good as it sounds that we can write off all these things, what can we actually write off? And I think people are really good about writing off their property related expenses, like mortgage interest, property taxes, management fees, software costs, and things like that. But I think what people most often miss out on are some of these expenses that are somewhat personal in nature, but we also use it for business purposes as well. So for investors everywhere, most of us are using a laptop or a computer to manage our properties, dealing with the guests. So, and you might from time to time, go on social media or do something personal with it, but nonetheless, if you have some of these mixed use expenses, make sure you're tracking and deducting the applicable business use percentage. Same thing with like home office. Most of our investors work from a home office. I don't think we have probably less than 12 people who actually rent an office space to deal with their short-term rentals. And so that's another, sort of must know that if you work from a home office to the extent that it's eligible, then you should be claiming the home office expense as well. I think the other common one that we see missed all the time is car expenses. So you can write off the business use of your car regardless of whether title of that car is held in your personal name or in an entity like an LLC or a partnership. What the IRS doesn't care as much in terms of who holds title to the car. They care more about your ability to document the business use of it. And business use, obviously would be you driving to your short-term rentals and dealing with that kind of stuff, but that's not the only business miles. It could be you driving to the bank, you driving to meet with a lender or a local real estate meetup. So just making sure you track all those what we call commonly missed tax deductions is really the foundation to having tax savings.
Cool. And then you talked about home office there. That's definitely a very common one. And you
Mhm.
talked about obviously you kind of have to think about what part of it is being used for business.
Mhm.
So how do people kind of figure out how much of their home they're using for business? Is it literally square footage and probably the amount of
Mhm.
time spent in it? How do they go about doing that?
Yeah. Great question. And so I'll kind of answer both of these for car and home office because those are like the most
Okay.
common ones that are personal and mixed use. What we generally tell our clients is you want to be tracking 100% of those expenses. So if we're talking about home office, you're tracking 100% of what you pay for the year, mortgage, taxes, insurance, cleaning, security, all those kinds of things. And what happens then is when you get your tax returns done, your tax preparer will take a look at the total expenses. And then you will also send them, like you mentioned, square footage. What's the square footage of my home office versus the entire home. We can also use a different method, which is looking at number of rooms. So the number of rooms, that's the home office versus total number of rooms. And what we're able to do is try to pick out the more beneficial percentage to do that calculation. So if in one example, for my scenario, I've decided that number of rooms gets me a higher percentage than looking at square footage, then your CPA can take that higher percentage, apply it to the interest, taxes, cleaning, security, and all that to arrive at your tax deduction. It's sort of similar with respect to cars. Like we want to track 100% of our car expenses, and then you're just tracking your miles for whenever I'm driving. If it's for business, I have a mileage, and at the end of the year, you come up with a percentage. You apply that percentage to the total expense for the year.
Okay, awesome. And then, a lot of the advantages that we're going to kind of get in today are kind of specifically focused around short-term rental. What is the definition for a short-term rental from a tax perspective?
Yeah, that's a great question. I'm glad you brought that up up front. So, contrary to popular belief, I think most investors think, hey, if my property is on like Airbnb or Verbo, that means it's a short-term rental. The IRS actually doesn't care where you list your property. Okay, so it could be your own listing, or you list it through a hospitable platform, you host it through Airbnb. That part doesn't really matter. What the IRS looks at is the average number of guest stays during the year. And so if you have a property and if this year, meaning January 1 to December 31st, if the average guest stay is 7 days or less, then that means it's a short-term rental for tax purposes. Alternatively, if the average guest stay is greater than 7 days, then it's not going to be considered a short-term rental. And this is true regardless of where you actually list the property.
Okay, great. And then really kind of getting into that, because I asked for the definition of short term, because I'm going to ask you another one very related question. Um, are there tax advantages for short term rentals versus, doing midterm or long term, or are they the kind of the same benefits?
Yeah, that's a great question. One of the reasons earlier I was talking about how we love short-term rentals as a tax strategy is because short-term rental is an asset class where you could be investing in a property that's just your side hustle. So you still have a full-time job, you're an attorney or a doctor running a medical practice, and even if real estate is your side job, you can potentially use all these creative deductions and write-offs and depreciation and create a tax loss and be able to use that loss to offset taxes, not just from the rental income, but also from your W-2 income and maybe business income or retirement income that you earn. And that's the key difference between short-term rentals versus long-term and midterm. So for higher income earners, and we typically define that as people making over $150,000, if you're a higher income earner and you're investing in regular rentals, which is long terms, midterms, and all those other types of properties, you can only use rental losses against W 2 income if you or your spouse is a real estate professional. And that's very hard for a lot of people to meet because one of the requirements is you spend more time in real estate than your job. So for all of you who are high income earners, it's almost impossible for you to also be a real estate professional. And again, that's why we love the short term rental realm because you don't have to be a real estate professional. We actually don't care how many hours you spend at your job, as long as you meet some of these material participation hours requirements, which I'm sure we'll touch on soon, then you are able to use short-term rental losses against all types of income.
Cool. And then we've kind of teased people in with this podcast title focused on loophole and short-term rental loophole. What is the short-term rental loophole that we want to talk about around taxes?
Yeah. Well, so the reason we call it a loophole is because traditional investments like long-term rentals, you or your spouse has to be a real estate professional to use it against W-2 income if you're a high income earner. And so, for the majority of people, if you're working full time, or you're married and you both work full time, it's almost impossible to use the long-term rental losses against W-2. So in the short-term space, we call it a loophole because you don't have to be a real estate professional and you are able to use those losses against your W-2 income. So it's a loophole really for high income earners who, if you're single, you're working a full-time job or running a business full-time, or for married couples, it's you both still working full-time somewhere, but just have real estate as a side hustle. So yeah, I personally don't like the term loophole, but it's sort of been coined that way in the industry. So we just continue down that path.
Awesome, that makes sense. And then you've kind of in your example you've kind of focused on more like individual hosts that probably potentially they have another full time job, they may only have one or two properties. When we start thinking about kind of cost segregation and the advantages to tax there, is that something that's doable for these kind of individual hosts that maybe have one or two properties, or is that just something for larger investors with hundreds of properties?
Yeah, I love that question. It's often another area of confusion that we get for people. So just real briefly, cost segregation, in the tax world, as investors, we're allowed to take depreciation on the purchase price of the building. So if I bought a property for $220,000 and I say 200,000 is the building, I generally can write off that building over 39 years if it's a short-term rental property. So that's just what the law allows me to do. But what we can do is even better than that. So the IRS allows us to do what's called cost segregation, which is often referred to as accelerated depreciation. And what that means is instead of saying I just have a $200,000 building, I'm going to break out the components of the building into specialty plumbing or fixtures and appliances. And with those segregated amounts, my CPA is going to take faster depreciation. So rather than waiting 39 years to take the benefit, I'm going to take it, some of that immediately over 5 years. And, in the past, it has been a very expensive undertaking for someone to do a cost segregation because you have to hire these engineers, they fly out to your property, they do all the study, and so it was expensive to get it done. And so historically we just have larger property owners like apartments, commercial shopping centers. Those were the people who did cost segregation. But several years ago, I think, maybe starting even before 2020 with COVID and everything, we all really learn how to do things remotely. And so with cost segregation too, it's like a lot of these companies no longer have to physically be flown out to your properties. And so what we're seeing is that the cost to getting some of these analysis done has come down pretty significantly. And when we combine that with, currently we have what's called bonus depreciation that basically allows us to kind of supercharge all those tax savings. What we're seeing a lot more is even for those single family homes, short-term rental with like one property, two or three properties, it often still makes sense for you to do a cost segregation. At the end of the day, what we're looking at is what is the cost for me to actually do a study, and what is the tax savings that I'm expecting to get? So if it's going to cost me $1,000 and I'm expecting to save $30,000 of taxes on it, then it definitely makes sense to do. Right. So that's what you just want to talk to your tax person and figure out, whether it's beneficial for you to do it or not.
Okay, cool. Yeah, that makes a lot of sense. So you're kind of talking about some, I guess, advantages and new things for people to be thinking about potentially that they might not already be doing already. But what some of the mistakes you actually see short-term rental investors make, and maybe some things that our listeners should, watch out for and not stumble into the same traps?
I think we covered, some of them already, right? Like just making sure we maximize our expenses and not leaving money on the table. The short-term rental loophole, we talked about how you don't have to be a real estate professional to use the losses. That's actually a mistake we see all the time not necessarily from investors themselves, but actually from CPAs. Because you figure there's like a large pool of CPAs or people who prepare tax returns, and those who understand or specialize in real estate is like a smaller circle. But even within real estate, it's like those who understand the short-term rental loophole is like even smaller. And so what we're seeing a lot is when talking to investors, their CPA will say, "Hey, you can't use short-term rental cost segregation because you're not a real estate professional." And so that's a mistake we see time and time again. So if you are someone investing in real estate in the short-term rental space, and your CPA is telling you something to the extent of you can't use losses or strategies because you're not a real estate professional, that's a pretty significant red flag that your CPA doesn't really understand the specific realm, because you're not required to be a real estate professional and you can use all those benefits. You do have to meet material participations though. So it's not just like I buy a short-term rental and I automatically get all these magical benefits. So one of the things, there's actually 7 different ways to qualify for material participation hours. The 3 most common ones is you and or your spouse spend at least 500 hours on the short-term rental properties. And so those are just like, you getting it up and ready, staging, furnishing it, dealing with the guests, dealing with the turnovers. I think most of our clients in Hospitable platform are self-managing, right? Which is really
Yeah.
great because all those self-management hours are really helpful in achieving that. But for those of you who don't meet 500 hours, another way to qualify is that you earn at least 100 hours on your short-term rentals and nobody else has more time than you. So in that scenario, we have to look at the cleaning crew, the repair people, how many hours are they spending? And we have to make sure we have more hours than each of those people. So those are, 2 out of the most common in the, 7 different ways to qualify. So if you're using the short-term rental loophole, really, really important to make sure you don't make the mistake of just assuming you qualify. We highly recommend that you track your hours, you're able to substantiate that you actually earned all those hours. Because, the tax savings that we see is pretty significant when we're talking about write-offs and cost segregation. It's often, $100,000, $200,000 in swing in terms of how much write-offs you get. And so you just want to make sure you have all your documentations in place. You don't want to be audited and then realize you can't prove your hours and get faced with like a huge penalty.
Yeah, for sure. And then when you're talking about hours, just kind of a couple of questions that kind of came up in my head as you were kind of talking through that. So in terms of proving hours, does kind of time spent on hospitable count towards that? That's kind of part of managing your short-term rental. Are those hours, part of the hours I've spent managing my short-term rental as well, even though you're not physically doing something in person?
Yeah, for sure. And that's a common misconception that people think I have to be there fixing the toilet, and that's not actually true. I
Yeah.
mean, you're out, I imagine nobody's hanging out on Hospitable just for fun. So when people are there, they're usually managing the properties, they're trying to manage their crew. And so yeah, property management hours definitely count. And a question we get often too is like, how do you track those hours? And the good thing is IRS actually doesn't have a specific requirement in terms of the methodology. So for some of our clients, they use Excel, others use a calendar. We actually have a client of ours who created an app. It's called Reps Tracker. And you can check that out. If you can go to keystonecpa.com/app/apps, and you'll be able to access that. I think you can test it out for free for like 2 weeks or something too. But it's a really great way for you to kind of have it on your phone where you could just toggle on and off when you're working on stuff. But yeah, property management stuff, time on hospital, most definitely would be, because you're just asking yourself, are these property management related hours, right? And if so,
Yeah.
they do. I can tell you what does not count. I think it's just as important for us
Mm.
to know what counts as what doesn't. So our time in researching deals, like you're ready to buy your next property, you're researching, those hours generally don't count because we're just trying to buy more real estate.
Yeah.
Learning about real estate usually doesn't count. But if you're doing research and analysis on like your existing property, you're trying to figure out how's my pricing, can I increase this? Should I adjust it? Those definitely would count as part of managing your portfolio.
Okay, cool. Yeah, that's very good to know. And I did say there's 2 questions. I think my second question was going to be when you talk about the 100 hours method, I guess, and being the person
Mhm.
that spends the most time on it. Is that literally you versus every individual, or is it you are the majority versus all of them added up together? If that makes
Yeah,
sense.
that's a great. So actually, so there's actually a third way to qualify, which, so we talked about, you at least 500. When you meet
Yeah.
500, we don't care about anybody else. Or you and your spouse earn at least 100, but nobody else has more time than you. The third way to qualify is just you having more hours than everybody else combined.
Okay.
And so that would be like, Miles spend 50 hours and then out of everybody else's time, it's only 30, then I also would have met that as well. So that there is that third way to qualify. And so so in that third manner, yes, we have to add up everybody who has participated or involved in the
Yeah.
property, regardless of whether they own it. In that second method where we're seeing 100 hours and more time than anyone else, technically they're talking about any one other person. So
Okay.
naturally, because our clients are super creative real estate investors, the question then they always ask is, okay, if I have a cleaning crew, then is it if I hired Molly Maid, is it Molly Maid, the company with their 10 cleaners, or is it every single, Mary came today and Natasha came the other day?
Yeah.
Is it each of those person? So I think when you ask different CPAs, you'll probably get different opinions on this because it's not something that's been tested thoroughly in tax court. Um, I feel like the interpretations have been it is a per person rather than a per company. However, for our clients, because there's not really case law to substantiate that, we typically recommend that we try to beat the company. So if it's Molly Maid, I want to have more than all the Molly Maid people combined. But part of that's a risk tolerance level, at the investor level too.
Of course. Of course. Yeah. There's some personal decisions to be made there, I guess, as well.
Yeah.
And then at the very beginning, you kind of touched on around the expenses piece, not having to have, or even if the property is held in an LLC and you own the home office that you're working out of, you can still claim that as an expense essentially. And you're nodding along just for anyone that's listening on the podcast. And then I just want to kind of ask, in terms of where the property should be held, I guess, are there tax advantages for a property to be held in an LLC or an S corporation? Is there any kind of reason around the decision there that we should be thinking about?
Yeah, that's a great question. We get this all the time. Like, how should I hold title to my short-term rentals to get the best tax
Yeah.
benefit? And I will say that, 99% of the time for short-term rental investors, whether you hold it in an LLC or a partnership or even in your individual name, the tax benefits are going to be exactly the same. And the reason for that is because those entities are what we call flow-through entities. And so the income and losses of the properties, even if you hold it in an LLC, it just flows through to your personal account. So you get the same benefits irrespective of how you hold title. Now, of course, an investor should always consult with their attorney to see if there's any asset protection benefits of holding title in an LLC rather than your individual name. But with respect to the flow through of tax benefits, it's exactly the same either way. And also with respect to write-offs too, like we were talking earlier, you can have a home office, you can write off your car irrespective of how you hold title to a property. So that makes it pretty simple. Now, earlier I said 99% of the time it's going to be in an entity, it's going to be the same. What's that 1% difference? Well, for some people, we rarely see this, but they do exist. Sometimes we have operators who kind of scale up their short-term rental game where it's not just a true short-term rental anymore. It's kind of veering into almost like a bed and breakfast or a hotel where they're doing more than just, hey, you come and then you leave. That, they're offering other things like excursions and hotel pickups and, food delivery services. So when you start to dive into some of those short-term rentals with service add-ons, what happens is then your rental income could be subject to self-employment taxes. And that's into like Social Security, Medicare, and all that good stuff. And so if you're one of those rare instances where you're operating your short-term rental almost like a hotel business, what we sometimes recommend is that you have a corporation to earn that rental income. So just to be clear though, we still want the property in your personal name or your LLC, but you might have another corporation that will earn some of that income. And the reason for that is S corps can help us to reduce some of that self-employment taxes that we would have to pay otherwise if everything was just in our personal name.
Awesome, that's good to know. And then we're kind of coming to the end here, Amanda, but I just kind of want to ask, is there anything else that you think we've missed? Any kind of key things that you want to really shout about and like make sure people go and do and think about as their next steps?
Yeah, I think I mean, obviously, if any of this is new to you, you definitely want to get yourself educated because this is really a must know if you're someone investing in the short term rental space. And I mean, you can visit my website at keystonecpa.com. We have a whole free tax savings toolkit on this short term rental loophole. And my husband and I also wrote a book that you can find on Amazon or Barnes and Nobles. It's called Tax Strategies for the Savvy Real Estate Investor. But I think, if you're investing in short-term rentals, it's really important to do tax planning. Because like I said, we don't magically get all these tax benefits just because we invest in short-term rentals. You actually have to be doing the right things during the year, like tracking the right hours, making sure you can prove your hours, figuring out if you should do a cost segregation and actually doing it and putting it on your tax return. So, although it's one of our favorite strategies, there's a lot of missteps that can happen. I know we try to touch on a lot of those today already, but really important to make sure that it's reflected correctly on your tax return because that's usually the last piece of the puzzle, right? We did everything, and then did it actually end up right on the tax return? So those are the things to, in addition to just being busy, being an investor, growing your portfolio, take some time to do some tax planning with your CPA and just make sure that you have all your ducks in a row.
Amazing. Awesome. Amanda, thank you so much. I think that's all we have time for today, but thank you so much for joining us. I'm sure the listeners will have enjoyed that.
Yeah, thanks for having me.
Great. Thank you very much, Amanda. And thank you everyone for listening in.